It's Brian Preston, the money guy.
All right, here's our next question. This is from Lucas. Lucas says, my wife has 6% student loans. We could pay them off in a year with our income. We are in our upper 20s. Should we still invest and pay minimums on this debt? So upper 20s, 6% student loans. How do they go about thinking about whether they should pay off the student loans or pay the minimum and invest the rest?
We've actually done a lot of work on this, and we even had some slides, but since it's a Q&A show, we don't have this. So go find some of our other content on debt specifically, because I know we've talked about student loan debt. And I'm going to do this because here's the analytics to what we've kind of figured out, and Bo can put some color to this too, is that we tried to figure out what the risk-free rate of return was historically.
Sure.
We tried to figure out what's the premium spread or risk spread that you get from putting your money to work by actually investing it. And we came up with kind of a laddered approach by decade, meaning 20-year-olds, 30-year-olds, 40-year-olds. Where did that shake out, Bo?
Yeah, so if you look at kind of historical numbers, assuming that there aren't unique things in your situation that would change what your expected rate of return are, meaning liquidity issues or that sort of thing, we think that realistically, if you're someone in your 20s and the interest on your student loans is above 6%, you should probably prioritize paying off those student loans because that is creeping into the realm of high interest debt. If it's below 6%, the value in your army of dollar bills is so strong that you may be missing a big opportunity to let those dollars grow. If you want to know just how big that opportunity is, go to our website, moneyguide.com/resources, and go look at how powerful are your dollars. And you can see that for someone who's 20, $1 can turn into 88 by the time that they get to age 65. So you don't want to miss out on that opportunity. Well, then as we age, our expected rate of return decreases. The power in our army of dollar bills goes down. So we think that if you're someone in your 30s and your student loans are above 5%, you should probably prioritize paying them off. If they're below 5%, you could consider investing and continue by the minimum. Once you get into your 40s, the number drops to 4%. And then by the time you get into your 50s, we don't really think you should have any student loan debt unless for some reason maybe now you're starting to take on student loans for the kids or you have something like that. But even if you're doing that, you want to make sure you have your financial foundation in place before you start taking on debt for a junior to start going to college.
There's also, we're in a unique time right now where student loan interest is waived until September of this year.
Yep.
So if you're trying to figure out, do I go get employer match or, firm up some things financially, now, especially where all of the interest, even though the stated interest rate is 6% on that student loan debt, there's a good chance that a lot of that is waived until after September. So take advantage of what some of the short-term things are going into it, and then Bo just gave the long-term perspective. Balance those two things and navigate it with the financial order of operations, and I think you'll be ready to tackle all things that come your way.